liars, but all right. Well, let's get started. Thank you everyone for joining this evening. I'm sure that if it remained 90 and sunny today, we would have lost some of you. So appreciate you joining on this stormy evening. For those of you who don't know me, my name is Jared Pollard. I am one of the board members for the Council of Urban Real Estate, better known as CURE. And I have the distinct pleasure of moderating this evening's discussion with two industry experts. We have Alex Jagendorf and Josh Pollard. Alex is going to be able to provide some unique insights surrounding OZs from a tax and deal structuring perspective. And Josh is going to share thoughts on the space, really from his on-the-ground experience as an OZ investor and a champion for urban communities. So in a moment, I'm going to formally introduce our two speakers and then start the discussion with 5 or 6 questions that I prepared based off of what folks said they want to hear about when they registered, and some topics that the panelists and I thought were going to be useful and helpful. And then I'm going to save some time at the end for Q&A. So if you do have questions, you can use the chat function, and we'll just queue those up. And at the end, we will, we'll try to run through as many of those as possible. So, so with no further ado, I'd like to now introduce our speakers. Alex Jagendorf is a senior manager in KPMG's real estate tax practice and is a lead senior manager on the East Coast KPMG QOZ team. Alex has advised on multiple QOZ fund formations and planning opportunities while serving premier New York developers and real estate funds. Prior to his role working on QOZs, Alex focused on tax structuring matters pertaining to real estate funds and REITs. Alex is a graduate of NYU Stern School of Business with a BS and MS in accounting. Thank you, Alex, for joining us.
Thanks, Jared.
Next, we have Joshua Pollard. Joshua is a real estate expert and chief executive officer of Amasello. The mission of Amasello is home, health, and wealth. In addition to chairing the board of Amasello Cares, the education-based nonprofit affiliated with Amasello, Josh is a board member for companies that are building entrepreneurs, supporting communities, and creating a 21st century workforce. This community-enhancing work earned Joshua an invitation to the White House to receive the President's Volunteer Service Award, among other awards and recognitions. Prior to founding Amasello, Josh led U.S. housing research for Goldman Sachs from 2009 to 2013, and he previously spent 5 years as a member of Goldman Sachs research team that found equity capital markets opportunities in the real estate, engineering, and construction industries. During his tenure at Goldman, Josh led research of a $1 billion real estate IPO and received numerous awards, including an addition to Forbes 30 Under 30. And the better fun fact is, Josh and I are not related, but share the same last name and started the same day at Goldman Sachs. So being Jay Pollard certainly confused a few folks, and I received many emails that were meant to go to Josh, had to get wall crossed on many of deals because of it, but we've become close friends over a year. So, thanks, Josh, for joining us this evening.
It's great to be here. Thank you, Jared.
So I want to kick things off, Josh. Obviously opportunity zones have been a hot topic for the past few years. There's been a lot of press, and the participants today have a varied level of knowledge and experience around OZs. So if you don't mind kicking things off by sort of providing a high-level overview of the OZ program. And then Alex, feel free to jump in and add anything else in this question as well.
Yeah, so a couple of things, and I'll just use this as a level setting opportunity. Opportunity zones really result in three benefits to investors and a few potential downstream benefits to communities. When it comes to investors, the three benefits are the deferral of taxes, the trimming of taxes, and the elimination of taxes. And you should be thinking about these three in three separate buckets because of the nature of what's being deferred, trimmed, or eliminated and what causes that. So from now until the end of this year, and it's been the case since this legislation was passed, if you take your own capital gains, money that you already have invested, you sell that asset, and as opposed to taking all of that home, you invest into a qualified opportunity zone fund or qualified opportunity zone asset, you can defer the capital gains that you owe Uncle Sam until 2026 or 2027. So that's step one, and it's a material benefit if cash flow is important to you and you would like to keep somewhere between the 20 and 40% tax that you would otherwise have to pay on capital gains. So step one, if you invest by the end of 2021, you can defer the taxes that you would otherwise have to pay this year. Number two, you are able to trim your taxes. The reality is that you can reduce the amount of capital gains that you would pay on your investment by 10%. And I'm using common language. I'm not talking about changing the basis. I'm trying to make it just extremely as plain as possible. But if you invest by the end of 2021, you can actually trim your taxes by 10% that you owe on your old investment. So you invested, you had $1 million in capital gains, the 20% that you would otherwise pay would be reduced down to, we'll call it 18% when it's due in 2026 or 2027. And then last and certainly not least, and quite frankly, the most important piece is the elimination of taxes. If you make an investment into an opportunity zone asset and you hold on to that asset for at least 10 years, when you eventually sell that asset, you will not have to pay capital gains on it. That is critically important and quite frankly, the largest differentiator in this program. What I would say is that how, if there's a question on how opportunity zones were chosen, this legislation was stacked on to the large tax cut that came at the end of 2017. And then it was given, the goal or the opportunity was given to each individual governor of each state to determine some portion of the low to moderate income census tracts where those were going to be determined to be opportunity zones. The reality is that they also were allowed a small percentage of low to moderate income adjacent census tracts as well. And that's been a key differentiator. At the end of the day, these neighborhoods, in most cases, are low to moderate income neighborhoods that quite frankly are in serious need of investment. But let me stop there and I'll turn it back over to you, Jared.
Yeah, we're gonna get there, Josh. I see your wheels spinning. You're ready. Thanks for that, Alex. Anything you want to add to that? Anything else that maybe Josh didn't touch on?
No, I don't want to steal Josh's thunder later on.
Okay. All right. So so the next question, and Alex, I want to start with you here, really on the regulatory front. It seems from an outsider's perspective that the regulations around OZs have been a little bit of a moving target. And, standing here today, 3 years sort of into the program, how would you currently sort of describe the regulatory environment as it relates to OZs? And what are some of the recent trends or regulatory updates that you're hearing as the Biden administration sort of sets to introduce their sweeping tax changes?
Sure, Jared. And really the way I would view the current environment is threefold. The first is talking about the bipartisanship that really created the program, a few years ago. Second is around ESG efforts that I'll just touch on. And then third, clearly the tax lens on top of all of that. So the program was introduced, when it was introduced, it was bipartisan. Two senators, Cory Booker and Tim Scott, one from an urban area, one from a rural area, both coming at it from really a different viewpoint. Ultimately, they hope to achieve the same goal, revitalizing some of these lower and middle income zones that were designated. And they were designated based on the census tracts that were determined back in 2010, which is probably an important piece of information to keep in mind. So when we're here 3 years after the program was created, we're talking about zones that are 11 years past that designation. And, some of them are, I'm in New York City, some of them are in Hoboken, Jersey City, areas that you look at and you think there's no way should be an opportunity zone. And then you have other areas that clearly are in need of investment. Now, the other lens to think about for the partisanship or bipartisanship is we're in the COVID era and a lot of these jurisdictions are hurting for cash. They have their budget and now they're looking at this program and they're saying, is this worth it? Are the benefits substantial enough? Or should we start taxing people? And New York, in their budget that came out a couple of months ago, they actually are decoupling from one of the federal programs, the deferral aspect that Josh was talking about, but they're allowing the 10-year exclusion on the back end. Then you have other states like California that just never adopted the federal version to begin with. So I think as states are looking at their budget, we're going to see certain conformity issues there. From an ESG perspective, I'll just mention that the Biden administration is looking closely at really the social benefits of the program. And today the reporting is very limited on the tax return effectively for what a qualified opportunity fund needs to disclose. So I think we'll see some introduction of additional reporting, forms, filings, et cetera, whether it's talking about the number of jobs created, revenue raised, or just investment dollars made into some of these zones. Ultimately, just additional disclosure. Now, from the tax side of all of this, some of you may know the Friday before Memorial Day, Treasury Department issued their Green Book, which basically explained the Biden administration's tax policy. And one of the key items on there was an increase in the capital gains rates for higher earners. Effectively, the 20% cap gains rate will go almost 40% for the higher earners. And what's interesting here is this is actually going to be retroactive, is what we're hearing, to some time and call it Q2 of 2021. The administration's concerned that there will be a massive stock market sell-off and people will time their gains if they don't make it retroactive. So we're in an environment today where for higher earners, capital gains are now potentially going to be up to 40%. And under the lens of opportunity zones and everything that comes along with it, suddenly you're talking about deferring a 40% gain until 12/31/2026 instead of a 20%. And then you're also looking at excluding 40% of the tax, or eliminating the 40% tax burden after 10 years. So it's definitely a much bigger lens to look at for opportunity zones.
Right. Yeah, that's really interesting. I hadn't thought about the sort of fiscal constraints on the states and how that may impact their sort of compliance or adjustments to the program. So that's very helpful. So the next question, and Alex, if you want to start here, and Josh, feel free to jump in. Can you talk a little bit about the current landscape and marketplace around OZs, and talk about some of the different players? To know you work on several different tax structuring OZ deals across the country. So if you could kind of give us an idea of the different players that are involved, and then give us some sense of whether that's changed. Are there new entrants into the market? Are you seeing any changes in sort of the supply and demand for OZ projects, particularly on the back of what you just mentioned around the potential increase in the capital gains tax rates? So just kind of help us understand that and what the current marketplace looks like.
Sure. And when everything was initially passed at the end of 2017, everyone, myself included, were thinking real estate, real estate, real estate. This program is sort of naturally designed to work for, construction of apartment building, a restaurant, a store, commercial space, et cetera. And with the final regulations that were passed about a year ago, we're seeing more and more entrants in the space looking towards operating businesses. And, some of our clients are looking at relocating their management companies into opportunity zones, telecom businesses or startups even. And if you consider if Facebook was started in an opportunity zone and venture capitalists put their money in for initial funding, with all these benefits, 10 years down the line, all of that appreciation would effectively be tax-free. So we are seeing an expansion from purely the real estate context, which is, I think, new and exciting. From a real estate perspective, though, I think the typical players in the market are, the mega funds, Skybridge and Brookfield out there. You have the developers, I think Bellpoint, RXR came out. And then you have the single asset deals or single asset funds. When zones were initially announced, we definitely saw a spike in prices for deals existing in opportunity zones. Funds were willing to pay a premium to acquire the land, the building, the materials that was already there. And then nowadays, with just the huge increase in raw materials, you're seeing even higher premiums being placed. I think we're going to see a flurry of deal activity in opportunity zones as we have the rising tax rates and capital gains rates, just the increase of everything. People want to move along the deals, and I suspect we'll see sort of flippers here. One of the requirements to have an opportunity zone deal is you basically need to satisfy that you're creating something new in the zone, whether it's renovating something or just building ground up. And the way the rules work, it's a quirky rule, but effectively, if you buy a building with everything but the roof on it, if the opportunity fund simply puts the roof on it, that's considered a new asset for tax purposes, and that fund can get all of the benefits, even though they put 5% of the cash into the deal. So I think we'll see people with deals in opportunity zones that either don't know what to do with it or have a project going on, selling these quickly. Now, the downside I will say is this could lead to certain inexperienced players entering into the market. We've seen people that are trying to do projects, which is not necessarily a bad thing, but it can certainly lead to many pitfalls here.
Got it. Thank you. Josh, anything you want to add to that?
No, I would simply say that the initial excitement has cooled off in certain ways on the real estate side, because when you look at the idea of being able to defer taxes, trim taxes, and eliminate taxes, it's like, folks' hands start to rubbing together pretty quickly. But what you realize is that if a deal didn't work for your returns profile, it was a very rare case that opportunity zone, adding the opportunity zone tax treatment to it, all of a sudden made it pencil. And so you saw this increase in price that Alex talked about from those who were selling land in opportunity zones. If you couple it with the fact that there's not a very deeply underwritable differentiation in returns, at least not in the time frame that's necessary for most investors, which is less than 10 years, then it just meant that many deals were sort of out of, a few more deals were out of reach that were already tough to pencil. When you add now the more recent appreciation in home prices and land prices as a result of the pandemic, it's created an environment where I think relative to most projections just around real estate, opportunity zone deals have underwhelmed those initial estimates of how much would be utilized.
Makes sense. Excuse my 1-year-old if you hear him screaming in the background. I think it's about dinner time. So that's his dinner alarm. Hoping someone feeds him. So you both sort of talk about pitfalls a bit. Alex, you mentioned, there's some new players coming to space, not as experienced, that may lead to some pitfalls. Josh, you're talking about, some deals that didn't pencil before, probably won't pencil after you layer it into opportunity zone. Can you guys, share some of the pitfalls that you've seen and that, this group should look out for if they do get involved in an opportunity zone fund or come across a project in opportunity zone?
Yeah, go ahead. You can go first, Alex.
All right. I think I would kind of classify the pitfalls into at least from my perspective, the tax technical pitfalls here. The program, when it was announced, the intention was to allow for as many people as possible to invest in opportunity zones, better the communities that were there, create some detailed requirements there that had to be met in order for taxpayers to avail themselves of these 3 benefits that Josh was talking about. Effectively, Congress and Treasury now, they don't want anyone to create a fund and get all these benefits from a tax perspective without, I'll say, doing enough for the community. Now, because of that, though, they had to balance how many or how much restrictions do we put on these taxpayers and on qualified opportunity funds and businesses in here, and then balance that from a real estate perspective, especially with, it takes time to build a building. And if you're developing, a 6-unit condo building like I have down here in Brooklyn, it could be fairly quick. If you're developing, a 30-story apartment building somewhere else, it could take years. So government had to create some frameworks that provide enough flexibility, but also allow the taxpayer to meet these requirements to avail themselves of the benefits. So sort of the first point I'll throw out there is there are a lot of tests that do need to be met by opportunity zone businesses and opportunity zone funds. The tests revolve around how much income you can have, where your assets are located, what assets you own, what assets you don't own or can't own, and then timing is layered on top of all of that. So that would be the first thing to look out for, is really just being able to meet all of the tests. And I think we're at the point where there are some open questions still. We've had multiple discussions with our other Big Four accounting firms, with Treasury Department. There are open questions that folks are looking for guidance on. But I think a majority are outlined and people sort of know where they stand at this point. Then you get into more of the, I'll say the hyper technical, where it comes about if you buy someone's interest in an opportunity zone business, that could potentially be problematic. So really structuring these deals the right way, looking out for refinancing, buying out a partner, the developer, for example, can lead to some potential issues. If it is sort of a straight up deal, you put money in, you develop the building, you kind of sit on it for 10 years. I think I'll say generally vanilla and probably not too much to fall into from a pitfall perspective. But when you try to do something more, that's where we see taxpayers get tripped up. And ultimately we see taxpayers that are trying to really stretch the intention of what you can do in an opportunity zone. We've had people talk about, can I do crypto mining in an opportunity zone? And when you look at some of these rules, it may work, but is this really going against the ultimate intention of the program? And I would say people need to keep in mind there are anti-abuse rules out there. If you're trying to do something that seems too good to be true, the government can always come in and overrule the tax advantages that you may get.
And I imagine that's when people like you come in and help those clients get back into compliance.
Yeah, ideally before they enter into it.
Yeah, right. Josh, anything else there around pitfalls that you want to add?
Yeah, I would say that it seems like a foot fault, but there's a lot of maps out there that are inaccurate. So a basic piece of advice would be is to make sure that you're actually in an opportunity zone. I thankfully have not made the misstep, but have heard stories of folks thinking that they were on the right side of the block and they were on the wrong side of the block.
It's a painful lesson to learn. So guys, we started to talk through some of this, some of the earlier questions that we've gone through, but I really love if you guys can walk this group through a typical OZ deal and sort of how it comes together. Talk a little bit about the capital raising process for OZ projects. I know in our call probably a week and a half ago, we chatted about this fundamental issue of matching asset allocators with developers or investors. And so there's it seems like there's this great need to help folks match opportunity zone projects with folks that are looking to deploy money into opportunity zone funds. So if you kind of talk about some of those challenges as well, I think that'd be helpful. And lastly, Alex, you mentioned crypto, so I'll go with that. Obviously crypto is a hot topic, probably hotter than opportunity zones at the moment. Right. And so if any of these folks on this call just sold some Dogecoin or some Ethereum or Bitcoin before the drop, or even better, sold some meme stocks in GameStop or AMC this week and are sitting on a six-figure or more capital gain, talk through kind of what they should be looking at for a potential opportunity to defer and eliminate those capital gains. I know you touched on it a little bit earlier, but if you could kind of take that real example and help folks think about what they could do as a passive investor in this space as well. That'll be helpful.
Yeah, so maybe I'll take the passive investor question, and then Alex, you can fill in with the first. I would say first take an honest look at what capital gains looks like for you, right? So long-term capital gains is likely to be somewhere between 15 and 20%. And short-term capital gains is likely to be somewhere north of 30, but south of 40%. So if you put money into, if you made money off of GameStop this year, you probably have held it for less than a year. So it will qualify as short-term capital gains. Selling it is going to cause you to have to pay 30 to 40% of what you owe back to our friend whose last name is Sam and first name is Uncle. If you wait a year, which might not be advisable considering all the dynamics of everything that's going on in those meme stocks, you will reduce the amount that you owe by roughly half. So there's a practical decision that you need to determine, which is how much of your gains would you like to be treated at 15 to 20% tax or at 30 to 40% tax. Once you get past that decision, you have the question of when do you want to pay the taxes and how long before you next need that money. When I think about that question, I say, if I'm not going to need this money for a very long period of time, or this is the part of my balance sheet that I'm willing to long date, I think the decision is relatively clear to toss that into an opportunity zone fund if you're able to. Again, it defers when that money would be due out to 2026, 2027. If you're able to pull it off this year, it'll reduce the amount that you owe by 10%. And that's using rough numbers. And then eventually on whatever new asset you purchase, you never have to pay capital gains on that future asset. To me, I've thought many times if I had a significantly larger bout of transactable capital gains, that I would be finding as many ways as possible to make sure that ostensibly the next generation of assets that I own don't have to pay capital gains on. It's pretty significant if you're thinking about it from that standpoint. So while it may be significant for very large sums, I think it too is significant on medium or small sums. And that's the way I think about the opportunity zone, structuring an investment and capital gains and what to do if you have some gains that are that you're able to transact on. I mean, the last thing I would add to that, Jared, just put it to you in this context. If I've been owning Apple stock since the 90s and I'm way up, and I assume that it's going to go up in a pedestrian fashion from here, or even that I have the opportunity for it to double and triple and quadruple again over the next 5 or 10 years. The reality is that you're going to have to pay whatever the long-term capital gains rate is in the future on that. Whereas you may be able to book your gains now, defer them and trim them, and then on whatever else you would gain over the next 10 years, be paying zero. Again, now that assumes that you can find a qualified opportunity zone fund asset that's going to appreciate at the same level as your Apple stock, which is not an easy thing to do. But given the pedigree of the folks on this call, my assumption is that that's very possible. And then it becomes a sound strategy. Alex?
And it's funny, Josh, you mentioned it earlier, and I think it's a key point to mention is that opportunity zones won't make a bad deal good. It can make a good deal great, but if there's a bad deal, the program will not magically create a good deal here. And when we look at, ultimately what the returns look like for the benefits along opportunity zones, and what we normally see is something like a 4% addition to your return purely from the tax benefits. So as Josh is mentioning, if you have a deal that even is a 6% return, on top of your tax benefits, you're probably looking close to a 10% return on that deal. So to Josh's point about it being no brainer, I would sort of echo that, so long as you're able to, hold off that money and really not touch it for 10 years on here. There are a lot of funds out there in the market from a passive investor perspective too. In preparation for this, I was just looking at lists of funds, and there are actually a few websites out there that do aggregate what opportunity zone funds are out there. It has contact lists for certain of the investor relations folks on there. So I would echo, to the extent you do have these large capital gains sitting around, there are quick Google will turn up, 100+ funds that are probably actively looking for capital. And, really it's as simple as that when you start investing into one of these funds. Alternatively, if you do have identified assets, that's a perfect opportunity, to kind of create your own fund of one, I'll say, and, set up your asset in there and just start investing that way as well.
And on the active development side, right? If you have owned some land, and let's say you've owned this land even before it was designated an opportunity zone. How should you think about it? If you're thinking about now developing that, because now that deal is much more attractive, there might be a lot more money available to get this project off the ground. Where does someone go? Where do they start? How do they, raise the capital to make that project viable if it's an opportunity zone?
So I'll start, and Josh, feel free to step in. I would say a lot of the wirehouses are looking at, some of these larger funds. If the goal ultimately is for a large asset, we see a lot of folks that are raising friends and family. If someone has $50,000 of gains, as Josh mentioned, AMC and everything else nowadays, there are some large capital gains floating around. And I think that's a perfect opportunity in the market for, not just friends and family, but you're not going to the wirehouses, you're somewhere in between, really, to get enough of a network to, raise a few $1,000,000, depending on the asset, or even more, clearly.
I would just add that, the one struggle about owning assets in an opportunity zone that were owned prior to 2017, or that weren't bought in the right structure, there's not an easy way to, for lack of a better term, grandfather those in. And that's no disrespect to anybody who's a granddad on here. But the truth is that much of this legislation is catered around either new or serious improvement of assets. So Alex highlighted a little bit of an accounting trick that folks are playing with opportunity zones that I'm not so sure is going to turn out well. And look, it concerns me whether or not that'll turn out well. But the other way to be successful in opportunity zones is to invest as much in repairing the assets as what you purchase, specifically the building. So one of the rules within opportunity zone is that if you bought a building if you bought a piece of property for $100,000, $50,000 of what you purchased was land, and $50,000 of what you purchased was the building, you must spend at least $50,000 or plus one in order to qualify. And so from that perspective, I think it's important to think about these as assets that are in need of real rehabilitation. And so one of the things that I haven't explored, but I'm curious on your opinion, Alex, if this is happening in the marketplace, are folks ostensibly swapping assets to try and solve for opportunity zone? So one person owns in an opportunity zone, but they've owned for a long time. Another person owns an opportunity zone and have owned for a long time. And they make the decision, I'll buy your asset and apply, and you buy mine and I'll apply. I'm curious if that's happened. I haven't heard of it.
Likewise, I personally haven't seen it, but I mean, there's nothing that would clearly restrict that.
I think you just came up with a market solution, marketing. That's great, guys. So I want to pivot the conversation a bit and go into a topic that I know is near and dear to Josh's heart, and obviously also has very close ties to CURE's mission around increasing diversity in commercial real estate. I know, Josh, you've have written a lot about this in Forbes as a contributor over the last few years, but can you talk about, OZ's impact on urban communities, right? We know what the intent was, but what has actually been the net result thus far from your perspective, and also its impact on affordable housing and diversity in commercial real estate. I know we've talked a little about like this program might have been set up for a trickle down effect, but is that actually, are the net benefits actually trickling down? And then maybe share some commentary on changes that either you or Alex would suggest, right? If you were brought in and asked for your advice on how they should adjust the program for going forward, or whether it's going to be extended, what things that should change in the next round. If you could share some of those thoughts, I think that would be helpful.
Sure. So the way I would describe the program, if I had to sum it up, would be a good heart, but a bad hand. What do I mean by that? It's simply to say that the idea of giving investors tax advantages for investing in US neighborhoods that need it the most is the right idea, and therefore a good heart. The ideal turned into execution that doesn't allow for community members who live in those neighborhoods to invest is where I believe that it's turned out to be a bad hand. I would put it like this. I did a study of the Federal Reserve Board's Statement of Financial Conditions in the US. And what you'll see over the last 35 years is that those who earn less than $40,000, their financial assets, so their assets that are not their individual house, have declined by more than 3.5% every single year for the last 35 years. So that's a compounding 3.5%. Put that in contrast with the top 40% of earners in our country, and their financial assets have grown each year, compounding 3 to 5%. You're talking about one of the most draconian periods of financial gap and wealth gap in our country. What the opportunity zone legislation has done is unfortunately potentially exacerbating it. How? You cannot benefit from opportunity zone legislation unless you have investable, transactable capital gains today. So you need to already have stock in Apple that you've owned for years, had enough to invest in Bitcoin 2 years ago, had enough in any one of your financial accounts to invest. And the reality is that the neighborhoods that are opportunity zones are traditionally neighborhoods where that's not the case. So I wrote an article in Forbes, and you know, I don't use this term regularly, but I thought it made sense as a title. It was, "Dear Congress, please extend opportunity zones to the poor." And it was ostensibly a request to allow, you know, my uncle, my aunt, who live in opportunity zones, who work diligently every day and bring home an income, allow them to invest $1,000 that they saved in the lot next door. And while they wouldn't necessarily need the deferral or the trimming of previous capital gains, allow them to get the 10-year capital gain elimination in their own neighborhood. When I push Congress on it, it was said, quote, "It would be too expensive." I don't believe it. I think that those are important changes that we need to fight for when the time is right, to ensure that there's financial inclusion in these types of laws. And to answer your question about the impact on diversity in real estate, I would say that it's a neutral impact. You mentioned Gerald trickle down. The unfortunate reality is that trickle down doesn't work really well. That original drop is a fraction of itself by the time it makes it to the bottom of the funnel, in the communities that need it the most. And so from that perspective, I do not believe that opportunity zones has in any material way changed how you know, the level of diversity in commercial real estate.
So before I go into the last question, I want to remind the participants that if you do have any questions, please add them into the chat, and then we will queue those up and address as many as we can with the remaining time. So please do that now. So, you know, we talked a lot about sort of where opportunity zones evolved from, what the sort of current market environment is around them, some of the evolving players and changes in the space, some of the pitfalls, some of the unintended consequences, and some of the missed targets maybe in the overall objective of the program. Having said all that, you know, looking at the fact that the program is slated to expire in the next 6 or 7 years, you know, would you recommend that Congress extends the program and provides additional extensions? And if so, you know, how should they change the program? You know, Alex, you talked about the fact that the census tracts are from 2010, right? What should they be doing to kind of refresh that and make sure that we're not reinvesting in communities that don't need the additional investments, and that we're taking a fresh look at other communities that desperately need this money, and make sure that we're not relying on trickle down to really get to the core impacts of low and moderate income communities?
Sure, Jared. And, you know, I will start off by saying there is some legislation, I think, sitting in the House Ways and Means Committee right now to actually extend the program for another 2 years to basically the last investment date and trigger date for the deferral currently is December 31st, 2026. So there is some talk about extending that literally 12/31/2028. I think everyone's viewing these last, call it 1.5 years, 2 years through COVID as a dark space, and just extending it 2 more years out. Yeah, I think as Josh alluded to, the program has the right idea. I think it's a really powerful program. I think it's could be very beneficial for the communities. I think right now, the way it's set up, it's clearly favoring the individuals with large amounts of capital gains that can make the investment. Ultimately, they will be getting the most benefit. But I think ultimately Congress and Treasury can look at what they possibly can do. And, Josh alluded to one way is to granting some tax benefits for individuals living in those communities. They can certainly target certain communities, whether it's refreshing based on the latest 2020 census, extending benefits into additional census tracts, potentially looking at giving further benefits for development, let's say, of low-income housing, or tacking on additional tax credits that exist out there. The supply for homes in certain areas is dire, and looking at what the program can incentivize companies to do, tax benefits, tax credits are just one way to do that. So I think it's definitely a tool that government has in their sleeve. I don't think the program as it stands today is going to be where it ends up, call it in 10 years or so. I think we will see some large changes in the programs themselves. And I am curious and excited to see where that does end up ultimately.
Yeah, I have the unique pleasure of being reminded by folks just a little my senior about enterprise zones that had familiar characteristics. I think that opportunity zones and things like it will be around in some form or fashion. They have been around before. They will continue to be around. I think that this current administration that couldn't be more opposite of the legislation that passed the opportunity zone legislation has in no way, shape, or form come out in any outrageous and negative way about it, which is probably the best signal that it won't change, at least under it won't change under under this current administration. And so you're really looking out to really only a scenario where there's a different democratic legislation or a different democratic administration that just is very different than the Biden administration, where this thing looks at risk. So another, if we shift back over to a Republican administration, it probably sits well, considering that it was, Trump legislation at the end of the day. Biden seems to be for it with some changes. I'm not seeing a path unless there's a Democratic administration that just absolutely hates it for it to have any issues.
Makes a lot of sense. A couple of questions have come in. One is there a time limit on OZ? And I'm not sure if that means in terms of how long the program lasts, or if they're talking about, for a single project, sort of qualify. If that person wants to clarify what kind of time limit you're referring to. I think that was Carol. In the meantime, let's move to this other question here. Can you elaborate on how to find and vet qualified OZ funds? Any thoughts on that?
I would say just in terms of, it's just really difficult, Henry. I apologize for not having the very best answer to that. But the reality is you want to make sure that they're doing it right. I think Alex mentioned the website that is allowing folks to be able to find those. But it's critical to find partners who know what they're doing first, because the worst thing you could do is be in an opportunity zone fund with someone who doesn't actually know how to do what's required for the underlying asset to be successful, because there's just no benefit if you're losing money. So I would look for a sound real estate developer or a sound venture capitalist who's having this as an additional benefit, as opposed to looking for an opportunity zone fund just for opportunity zone fund's sake. And the reality is to get the real benefits, you need to be in it for 10 years. And so I would think about it just like any other long-term investing strategy.
I would completely agree with that. I mean, look for someone who this is not their first project. And that's probably a good rule of thumb here. And this is just a new fund that they are launching, and they have experience in the space, and they're not, let's say, brand new to real estate. And that's probably a good rule of thumb for vetting a lot of these opportunity zones.
And to answer Carol's question about for a single project, how long do investors have before the program expires to invest in opportunity zones? So I did want to make a correction to what I said at the very beginning. If you invest in an opportunity zone fund, you have all the way until the end of 2026, and you will be able to defer your taxes all the way through that period. So if you invest in a fund in 2024, you won't have to pay your capital gains tax until when you file your 2026 returns, which is in 2027. So you have all the way until 2026 to invest in an opportunity zone fund and still be able to get the benefit of deferring your taxes, as well as not having to pay any taxes when you sell that new investment. The program officially expires, and it's like a very curious thing to see what happens in 2047 or 2048, when opportunity zones literally go away as the legislation is written today. So does that mean that everybody who owns an opportunity zone asset has to sell in 2048? That just remains to be seen.
Makes sense. And then Darren asked a question around increase in interest in OZs with the prospect of 1031s going away. Has that come across either your desk from a demand perspective?
I think it's an interesting question. We've talked to some of our clients about actually the ability to combine 1031 exchanges and layer them into opportunity zone funds. Ultimately you have your 10-year hold, but if you want to hold your asset, for the typical, call it 6-year hold period, right? It's fairly straightforward to stack the 1031 benefits into the fund, hold 2 assets for, call it an 11, 12-year hold period, and effectively you can negate the tax on the back end. I think with 1031s potentially going away, I haven't heard yet of any increase in attraction to opportunity zones, but that is certainly possible. I would be very surprised if the real estate industry got an exception to the elimination of 1031s. They sort of slipped through the cracks, or real estate was able to get through there last time. The different administration, different president, I don't think that's going to be the case this go around.
Got it. All right, well, thanks. I think, we've come up against the hour, and, first I want to thank, on behalf of the board of CURE, I want to thank our 2 speakers, Alex and Josh, for your thoughtful remarks. I think, you helped us better understand where the market stands today and where it may be going in the future from many different perspectives. So thank you for that. And I want to thank all the participants for joining today. We hope that you got as much out of it as we did, and we look forward to staying engaged with all of you. If you want to learn more about the organization, please visit our website, www.cureny.com, to learn more about the organization, as well as opportunities to become a member and get involved with some of our working committees. And then lastly, I want to give a quick plug to our member-only meet and greet event, which is happening Thursday, June 17th. And it'll give you opportunity to network with the board and other members of CURE. So with that, thank you, everyone. Have a great night and stay safe.
Thank you.
Thanks. Be well.